the best of Money Matters.
Market View on Money FM 89.3.
That's right, you're tuning into Money FM 89.3. Time now for Market View with me, Chua Tian Tian, where we take you through how the Singapore stock market ended the day, the biggest movers, sectors, and of course the companies to watch. But as always, a quick recap of some key movements. Well, Singapore shares rose today to track regional gains. So if we look at the Straits Times Index, it was up 0.97% at 3,896 points at about 2 p.m. Singapore time, with a value turnover of 759 million Sing dollars in the broader market. Now let's take you through the closing numbers. As we shared with you earlier, the STI closed up 0.92%, looking at 3,894 points. In terms of value turnover, we're looking at 1.37 billion Sing dollars. Gainers outnumbered losers, 362 versus 174. Top advances for today, we've got for you DBS, New Incorporation USD, and UOB. And top decliners, we've got here Asus, Jardine Cycle and Carriage, and Zhongmin Baihui. Now, in terms of companies to watch, we have for you Sembcorp Industries, because the company responded to a Bloomberg report which said that Sembcorp could be considering going private or selling assets as part of its strategic review of the business. Now, elsewhere, from a search in Chinese tech firms today to what to look out for at Nvidia's annual developers conference held in San Jose, we've got more international and corporate headlines in focus. And also on deck, U.S. retail sales rising less than expected in February, and what that means for Wall Street investors. Now, lots to watch, and joining me on the line today is Audrey Ho, investment counselor, Citigold Private Client at Citibank Singapore. Audrey, welcome.
Hi, Tian Tian. Nice to speak with you again.
Great to have you join us again. And Audrey, let's start with the U.S. this time around. I mean, U.S. retail sales up 0.2% on the monthly basis in February, higher than what's seen the month before, but below analysts' expectations for a 0.6% increase. Now, how did Wall Street investors react to the numbers? How far did it trickle down to Asia today?
Okay, so we saw U.S. stocks again gaining last night for a second straight session after a so-called 4-week tumble. What we saw for the past few weeks was that Friday activities tend to be driven by shorts covering their position than actual buying. So hopefully the recovery continues tonight. As you mentioned, retail sales rebounded marginally, but all in all, the softer reading reinforces the narrative of a slowing economy in the U.S. This is especially, I think, after last week's weaker than forecast CPI data as well. I guess everybody is holding their breath for reciprocal tariff announcements that are expected to come on the 2nd of April, and also the magnitude of, as we know, federal job cuts currently sweeping the U.S. You asked about Asia. So Asia is up today, tracking last night's positive performance in the U.S. For example, if we look at HS Hang Seng Tech, it is up 4% on the back of terrific 10 names like Baidu, Baba, JD, Tencent, Xiaomi. All of them are posting very strong gains today. In other regions like Japan, we see that Topix and Nikkei are also higher, with the dollar-yen back up above 149, with industries like insurance as well as banks leading the gains in Japan.
And back to the Singapore stock market as usual, Audrey, how did the STI fare today? Any surprises when it comes down to the biggest movers, particularly Sembcorp Industries, after it responded to that Bloomberg report?
Well, as you mentioned, the STI is up slightly less than 1% today. The largest contributors today came from Genting and Seatrium. Both of them were up more than 2.5%. Of course, the local banks constitute a very large weight of the STI, so them doing around 1.5% also lent a lot of support. When you spoke about Sembcorp Industries, I think when news broke yesterday of their possible restructuring efforts, the stock had a very large intraday jump of more than 5%, but ended the day just up 2.4%. So the last time this happened was in 2020, when they demerged from Sembcorp Marine. And I feel like, it's not uncommon for companies to do this if they feel that such restructuring efforts can allow different business units to focus on their respective fields.
I see. Well, in terms of the other companies to watch on the SGX, Audrey, we have ST Engineering, because today ST Engineering announced plans to propose an increase in its total dividend to 18 Singapore cents per share for FY 2025. If we look at the prior financial year's proposed dividend, that's 17 Singapore cents per share. I know by and large you don't comment on individual firms, but generally speaking, how would you assess the dividend yields out of SGX-listed firms this season, including at ST Engineering? What's driving dividend yields now?
I think, let's take a step back from whether it's ST Engineering or DBS or Singtel. All of these companies recently stepped up the dividends at the recent earnings, right? So let's try to understand what it means if a company steps up their payout rate. So, companies are supposed to use their net profits to increase shareholder value. And there are many ways that they can do that. For example, they can reinvest into the business, increase capital expenditure for a new machine or new technology that they feel can improve efficiency going forward, and so allow them to generate even more profits. Other ways include redistributing it to shareholders in a form of dividends or conducting share buybacks.
Yeah.
Right. So if we break this down, we see that certain industries are more likely to return money to shareholders via dividends because the company may already be at a later stage of growth, or maybe they are in a very mature industry. So since there is nothing meaningful to invest into, they might as well redistribute their profits back to shareholders in the form of dividends. I think it's also important to consider the geography and the culture. So, for example, if we look at U.S. companies, they don't like distributing dividends because, firstly, there are tax implications. So, for example, in the U.S., there is a high tax rate on dividends versus capital appreciation or reinvesting back in the business. So, tax implications could be a reason why they don't really distribute much. Secondly, it is also a signaling effect, right? Just now you mentioned the ST Engineering, they were at 0.17, they stepped it up to 0.18. So, what are the implications of that? So, there is that signaling effect. Because the moment they cut dividends or the moment they stop dividends, investors might take it, as maybe the business is not doing well, which may not necessarily be the case. So coming back to U.S. equities, for example, buyback yield, which is the yield that investors can get as a result of stock buybacks, it can form 80% of total yield versus 1% of dividend yield. So there is a very stark difference there. So bringing all of this theory back to a real-life example, Citi is positive on Japanese equities, right? Which is another interesting market because with the recent corporate governance reforms, what we have seen is that Japanese companies that were very used to hoarding cash for, call it 10 years, 20 years, are now both distributing dividends as well as looking for business opportunities that can expand shareholder value. So conducting, efforts like your M&A, your capital expenditure spending, all of these reasons are probably are the reason why they have done so well over the past 2.5 years.
And from ST Engineering, another counter made the headlines today, Audrey, is NIO, because shares of NIO this morning up 16.7%, and that's after the announcement of its partnership with CATL to create a battery swapping network. Again, broadly speaking, right, how important are such partnerships for EV makers in gaining this competitive edge against other industry players in this red hot, or some would say somewhat saturated industry already?
Yeah, that's true. I think it's important to recognize that our world now is becoming increasingly connected. So it's not sufficient to just build hardware if there isn't a software that's compatible with it. Similarly, what we've been speaking a lot about, AI, learning models, all of these are useless without the device, the hardware that are used to run these models. Right. So as we move towards an EV society, and I think especially in the case of China, where NIO is, in the case of China, EV penetration is 50%. Out of every 2 cars you see on the road, one is an electric vehicle. And new cars that are being sold, 90% of them are EV. So to such a society, such a culture, I think having a functional and efficient car is key. So many times for these companies, the issue is not so much in the demand, but the supply shortage, which is why this partnership for NIO is crucial, because it mitigates a lot of concerns that people have about the reliability of what keeps the car usable, right? The battery, that's the single most important thing for an EV. And it's quite interesting to note, that in China, there are more than 50 EV companies. You mentioned that it's a very saturated market. That is true. There are more than 50 players in that field, but less than a tenth of them are profitable. So I can imagine that, in the next 2-3, in the next few years, there is going to be a lot of consolidation on the China EV market. And I think locking up all the key suppliers, the key manufacturers, all of this would be key in how to determine how the game is played moving forward.
If you're just tuning in, we're now in conversation with Audrey Ho, investment counselor, Citigold Private Client at Citibank Singapore. Well, across the region, Audrey, all eyes are on the Greater China region. Hong Kong, for one thing, led gains today thanks to the buying of Chinese tech firms, as you mentioned, Alibaba, Tencent and JD.com. BYD also in the spotlight, jumping more than 6%. After it unveiled battery technology that it says can charge in 5 minutes. But the bigger question, I suppose, Audrey, is how sustainable can this optimism in Chinese tech firms be given what is going on in the US when it comes to Trump's trade policy? I mean, how far will investors shift their focus from the US to Asia, and is this for the long term?
This is a very good question, Chua Tian, because it's something that we speak to our clients about on a daily basis. Whether we're speaking with our institutional partners or whether we're speaking with our clients, all of them and all of us have the same question, whether or not it's going to be, this crazy rally that we've seen, is it sustainable? And I would say that 2025 has been a year of incredible rotation, out of the US, not only into China, but into Europe as well. Out of Magnificent 7 names into the terrific 10 names in China. So our view on China was neutral from last year, but we have recently gone overweight. And we believe that this round is different from the past 2 years, where we have seen Chinese equities rally 30% only to unfortunately deflate after 1 month or so. So a couple of reasons why we think this time is going to be different. Firstly, I think a lot of the previous rallies, they were based on hope for stimulus from the CCP, from government, which did not come true. Unfortunately, they had the meeting just 2 days before the US election, so the timing was just not correct because they wanted to wait and see who the next president was going to be. So a lot of the rallies were based on the hopes for stimulus. But this year, we have seen many instances where the government has come out to commit to a more proactive fiscal as well as expansionary monetary policy stance. So that's number one. Number two as well, it was difficult, I guess, for them to juggle so many things at once. And the domestic property market was arguably top of mind for many locals, right? So since then, they have managed to somewhat stabilize the market by implementing very targeted policies to address the oversupply of houses. So even if the prices of these homes are not recovering, they have at least stopped plummeting. So they can at least shift the attention away from, diverting all the effort into that local property crisis. And thirdly, and I think this is very key. Once again, coming back to the signaling effect, this is very key. We saw that at a recent meeting of business industry leaders for the first time in 6 years. How we had, Jack Ma, he was in attendance. He even had a chat. He shook hands with Xi Jinping. So although there was no formal change to regulation per se following the meeting, I think investors took it as a very positive sign, as President Xi was seen to be a lot more supportive of the private sector. So all in all, I think we expect momentum in the Chinese markets to continue, of course, contingent on the fiscal policy that we expect to be announced, say, around middle of this year. That said, U.S. equities, now that the rotation has been happening, U.S. equities are a lot more attractively priced. We started the year with the S&P at 5,009 with just 8 to 10% upside to go to our 6,005 target for year end. But right now at about 5.6, 5.7, I think the risk return is getting a lot more comfortable for many investors.
Now, further away, Audrey, this is a counter that we have been talking about for quite some time, Nvidia. And in fact, Nvidia CEO Jensen Huang, he's expected to showcase cutting-edge chips for AI and quantum computing today at the firm's annual developers conference. Now, of course, we don't comment on things that are company-specific, but generally speaking, if we look at the different developer days, what are we setting our sights on in terms of the comments and in terms of the signaling that could help us glean into the semiconductor or the generative AI space?
Well, I think following Nvidia's recent earnings session, it would be what would be interesting, right? Would be pipeline updates, especially for the Blackwell suite of products. I think investors would be keen to understand, not just from Mr. Huang, but other industry leaders in the semiconductor space, about potential China impact, both tailwinds as well as headwinds. Maybe a bit of color around DeepSeek and respective AI technologies, and maybe support for the broader AI spending theme. So, if you were Nvidia, if you were Jensen Huang, what will the largest customers, the Magnificent Seven, will they continue to splurge on the AI infrastructure? Other indications like how backlogged are they in terms of catering to demand? We know that previously there was a 2-3 year backlog. Is that 2-3 years still there? We believe that the AI theme will continue to be an unstoppable trend moving forward, but perhaps annualized returns could slow to a more sustainable pace compared to the past 2 years of extraordinary growth.
And a very quick one before we let you go, Audrey. I've got about 30 seconds to go. Fed officials, they are set to meet today and tomorrow to discuss the outlook of rates, of course. Widely expected to hold rates, but what are you expecting when it comes down to the dot plot?
Well, it's interesting because we ended 2024 expecting 3 rate cuts, right?
Yeah.
And then President Trump came in January, and then all of his policies were very inflationary in nature. And then there was a very harsh re-rating of yields at the start of the year to align market expectations with the Fed. And so they were only looking at 1 rate cut for 2025. But that said, with the recent volatility over the past 2-3 weeks, and with all the soft economic data, retail sales, CPI, unemployment, etc., the probability of cuts are now increased to twice this year. So Citi is expecting the first in July, and then the second one closer to the end of the year.
Okay, lots to watch.
Hopefully that's 30 seconds.
Yeah. Thanks so much, man, Audrey. That was Audrey Ho, investment counselor at Citigold Private Client, Citibank Singapore. Thank you so much for joining us on Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance.